Interest rates are dropping, but will the home prices follow suit? Many people assume that the lower rates mean higher home prices, but we've seen the home prices plummet over the last 6 months. So in today's video, we're going to talk about the interest rates. We're going to talk about how the potential dropping of the interest rates might actually affect you. We're going to show you what that payment structure might look like on the potential low end of those payments versus what we're looking at today. We're going to talk about who might be able to take advantage as the market changes moving forward. And of course, we're going to talk about the buyers and how a lot of them are still sitting on the sidelines. And there's one reason in particular why they are not making the move right now. So let's get into the video here. The interest rates, they're not going to end up back at 1%. Please don't. I think the lowest I saw out there was like 1.24 when we were at the low end of things on the variable side. But the reality is the 1% interest rates, I don't think that's something that we're going to see again. Of course, I could be completely wrong, but we saw the mess that those low interest rates has created. And I don't know if we want to actually go and replicate all of this over again. Right now, as it stands, we've got 7 rate decreases in a row, which is fantastic. We keep seeing quarter point reductions, and there's murmurs out there of a 50 basis point reduction coming up at the next meeting in April, which would hopefully move the needle or at least give a little bit of grace to those who are on the variable side of things. And I know there's a lot of people, including myself, who ended up with a variable rate mortgage. Historically, it was the way to go. It made the most sense. And especially if you have a job where your payments are not coming in the same time or the same price every single month, it's okay. Go variable, take that risk if it's something that you want to do, which is what I did, and it didn't pan out this time around. Now, a lot of people that have done that are going to be jaded. When we come up for renewal, we may not be willing to take the risk that we took last time to ride this crazy roller coaster of interest rates. And you might see a lot of us go to the fixed rate route. But as it stands, we're still riding the wave. We hopefully are going to see more reductions coming. So what I think we're going to end up seeing is the Bank of Canada, obviously, they are definitely worried with the tariff situation. Is the tariff situation going to be permanent? Is it going to be a short-term thing, a long-term thing? Is the tariff thing going to be a non-issue by the time this video hits YouTube? We don't know. We're hearing a lot of talk in the news about tariffs and how it's affecting our Canadian economy, and it hasn't even fully taken form yet. So we're going to see some Bank of Canada adjustments to kind of mitigate some of the tariffs, I'm sure. We're going to see a lot of hesitation from the buyers out there because they don't know, first of all, what tariffs are, how they're going to affect the economy. A lot of hesitation is what I think we're going to see from buyers. But I think long term, when we're talking interest rates, from where we are today to where maybe that bottom out is, I don't think personally that we're going to go below 3%. I think 3% is probably that baseline of what we might see. Reality is maybe 3.5% to 4% is where we're going to see a lot of the mortgages kind of settle because we've learned our lesson with what can happen with the lower rates. Now, if the housing prices would have come down a lot more from the peak, I wouldn't rule out the lower rates, but because they haven't come down that much, we don't need to see condos for 700 grand for a 1-bedroom. It just doesn't need to happen. So I think there's a little bit of kind of mitigating what the market can and can potentially do to just ruin things even further if the rates go down. So that's something we need to consider as we see these rate reductions continue to happen. Now, of course, rates are coming down. This is great. The fixed are coming down slightly. The variable have come down 7 times, like I've mentioned, but the economy is not in good shape. Everything costs a lot more money, and that has not changed. Aside from these variable interest rates, your groceries are still just as much. Your gasoline is still just as much. Your home insurance has probably increased. Your maintenance fee on your condo has also probably increased. So you go to the grocery store, everything is the same, if not more than it was 3 or 4 years ago. So yes, we can take advantage, of course, on the mortgage side of things if you have a variable rate, but that's the only thing that we're seeing in the whole Canadian economy that is actually coming down in your out-of-pocket costs. We also have the issue for people of, is my job actually a job that's going to be secure? If you're in the steel industry, if you're in the auto industry, right now your job is not secure. It may be non-existent at the moment. You might be on furlough from your company. Your company might be handing out letters letting you know that they are not going to be moving forward with you as an employee. So your job security is something that's really up in the air depending on the industry you're in, and we don't know what industry is going to be hit next in this Canadian economy. Will it be something like real estate? Who knows what the next industry will be, but the job certainty is something that's really going to affect the real estate market as well. You can't have lower rates and all these other issues and expect the housing prices to go up. This time it's definitely different. So the prices, they haven't crashed, like we said, and the rates have already started to get lower. And you're seeing on every single video where we're talking about it, there's less transaction volume happening. The prices are still decreasing. They're not decreasing at a rate of a jump off a cliff, but they're still coming down month over month. So there's a lot of people who don't really want to reach out and grab that falling knife. And I personally don't blame them. I don't think I would want to do that either in today's market. There's some circumstances where it makes total sense to get into the market, but everybody's situation is definitely different. If you need to kind of go over your situation, you can always text me at the number on screen here. We can talk about if it makes sense. Some people are calling me, telling me their situation, and I'm telling them I wouldn't personally go for it. And others, we talk through their situation and it makes complete sense. One of the biggest reasons that I think this market is not going to spike up, even if the interest rates continue to come down, is the buyers have a fear. And the fear that the buyers have right now is ending up like a lot of people who have bought in 2022, even in the end half of 2021, in these peak markets, who now find themselves in a financial situation that is not fantastic at all. So I think people have this fear of overpaying in today's market and then realizing in 2-3 years that my house is not even worth what I paid for it. Maybe I didn't even put a huge down payment in, and you're really looking at a mortgage that's unrealistic for you to continue paying. This is what I think people are most afraid of. So we're going to see the sidelines just filled up with potential buyers who might be able to afford a home. Maybe the affordability is not the issue. Maybe it is the fear of them actually getting into a market that is coming down and trying to time the bottom. We all know how it works with stocks, with real estate. You can't time the bottom of anything. You're probably more likely to catch it when it's back on the upswing. Now, a lot of people, they would much rather catch it on the way up again instead of catching it and it continues to fall after you've just moved into your first property. That can be something that really plays with your head. Now, what I want to do right now is kind of show you what the impact would potentially be from today's rates. We're going to use a 5% interest rate compared to what that 3% interest rate looks like. So on the screen, you're going to see it on either side of me here. First, we're going to use the baseline of a $600,000 home. This could be a home outside the GTA. This could be a condo in the GTA or downtown Toronto. We're going to use a 20% down payment. We're going to call it a 25-year amortization at a 5% interest rate. So the numbers you're looking at here are just mortgage. We're not including taxes. We're not including any additional costs. I don't want to get too into the weeds here. I just want to make it simple for you. So that mortgage payment is going to be about $2,806 per month. 57% of that payment is principal, 43% is interest, and the breakdown is right here on the side. So $600,000 purchase means a $480,000 loan. $120,000 is what that 20% is for your down payment. Now, over your whole mortgage, 25 years, you're going to be paying $841,000 for this home, which in turn means $361,000 of this purchase is actually interest. Now, let's look at what that 3% potential, of course, this is all hypothetical, what a 3% rate looks like compared to that. So not only are we now looking at a $2,276 monthly mortgage payment, which sounds quite a bit better. We're talking $600 a month less. Also, your down payment is the same, but you're looking at $202,000 of interest. And in the grand scheme of things, that's only 30% interest and 70% principal, opposed to 43% interest and 57% principal. So this is kind of the impact of what these rates could look like for you as they continue to come down. So yes, the rates coming down will make things a lot more palatable for the buyers to maybe hop into the market. They're going to have these fears and you have to decide if it's worth it for you look at your numbers, make sure that it makes complete sense, and understand the cost of actually getting in to the real estate market. So you have, of course, your down payment, you have your mortgage costs. You need to understand there's additional things that are always going to tally up here. Your moving expenses, your land transfer tax. This is just your mortgage payment, but I wanted to show you guys here what that actually looks like when you're looking at the difference between a 3 and a 5% mortgage, because your land transfer tax will be the same. Your moving costs will be the same as well. Your property tax is going to be the same. It might increase slightly year over year. And I'd keep my eye on this summer. Summer is generally a quiet time. End of June is when things kind of taper off. June, July, August, generally slower real estate months. So if you're thinking of maybe buying in this real estate market, you're going to see a lot of people will take vacations, their kids are off school, so there's less people who are actually active in the buyer side of things in the real estate market. You might see less listings as well, but those who are listed are actually trying to sell their home, and they might need to sell their home. So that's an opportunity for buyers out there to actually get their feet wet, go look at some homes, see if something lines up on the financial side of things, see if it makes sense for you to get in the real estate market. But what I want to know from you is, if you're considering, if maybe you're a future home buyer, would you try to get into the market and time it on the way down, or would you rather catch it when it's climbing back up? Thank you so much for watching this video. And if you're curious on what's happening in the real estate market, some of the losses that people are seeing, I've got 2 different videos here that are just showing you what's happening in the market, how aggressive some of the losses people are seeing from 2022 till today. Thank you so much for watching, and I'll see you in the next one. Bye for now.